The best teacher. Crashes are rarely unprecedented. They follow patterns shaped by speculation, excessive leverage, and human overconfidence. The more you study prior downturns, the more you recognize the recurring themes. The overextension of credit, complacent risk management, and the sudden shift from euphoria to panic. There's a quote often attributed to Buffett: "Only when the tide goes out do you discover who's been swimming naked." It's a vivid metaphor for the hidden fragility within markets. A lesson in prudence, humility, and preparation. And it's a lesson that extends beyond investing. It's about understanding the consequences of overreach, whether in finance, business, or personal decisions. As we think about the next crash, this perspective becomes a lens for interpreting news, financial reports, and investor sentiment. Buffett's secret prediction is embedded not in sensational headlines but in the quiet accumulation of risk signals, in the observance of fundamentals, and in the disciplined avoidance of hype. And while the public often focuses on sensationalized predictions from media personalities, Buffett's method is to watch silently, analyze thoroughly, and position strategically. That's why he repeatedly emphasizes cash reserves. The power of liquidity cannot be overstated in moments of market dislocation. Being able to deploy capital when others are forced to sell creates an advantage that compounds in ways ordinary investors rarely witness. And beyond finance, there's a philosophical underpinning here. Buffett's approach aligns with the teachings of Stoicism, valuing preparation, resilience, and rationality over emotional reaction. He demonstrates that the greatest opportunity often comes from the intersection of patience and courage, when the market's irrational behavior diverges most sharply from intrinsic value. Imagine applying this mindset to everyday financial decisions. Whether choosing investments, assessing risk, or considering leverage, the principles remain the same. It's not speculation that matters, but discipline, study, and the willingness to act when opportunity arises. And this is where his secret prediction truly reveals itself. The crash is inevitable, not because of any specific trigger but because of the cyclical nature of human behavior, market mechanics, and the accumulation of risk over time. It is less a prophecy of doom than a strategic insight into preparedness. Buffett's entire career illustrates the benefits of thinking long-term, avoiding panic, and capitalizing on the irrationality of others. He reminds investors that market declines are not to be feared blindly but to be understood, analyzed, and utilized as opportunities for those equipped with knowledge, liquidity, and patience. This approach is not just theoretical. It is practical, actionable, and historically validated. The contrast between those who panic and those who remain disciplined is stark, and it is precisely in these moments that wealth is preserved and often grown. And for everyday investors, the lesson is clear. Align your portfolio with value, maintain flexibility, understand risk, and never underestimate the psychological factors driving market behavior. Consider also the role of diversification in Buffett's thinking. Not simply spreading bets blindly but understanding correlations, resilience, and potential vulnerabilities. Diversification here is not an end in itself but a tool to manage the unexpected, to withstand shocks, and to provide optionality in turbulent markets. And while the headlines will scream panic during the next crash, Buffett's guidance would likely emphasize calm, observation, and decisive action when opportunities arise, echoing the timeless wisdom of sages who taught that preparation and foresight are superior to reaction and impulse. The deeper point is that the next crash, whenever it comes, is not an isolated event. It is a mirror reflecting human behavior amplified by leverage, speculation, and systemic vulnerabilities. Recognizing this allows an investor to navigate it not with fear but with informed confidence. And in reflecting on this, it's worth noting that Buffett also stresses the importance of continuous learning, of remaining intellectually humble, and of constantly questioning assumptions. Markets evolve, new risks emerge, and no formula guarantees success. Yet the principles of patience, value orientation, and psychological insight remain remarkably consistent. The secret prediction is less about timing and more about readiness, about understanding that the seeds of the next crash are sown in periods of overconfidence and ignored warning signs. Those who internalize this and act accordingly are the ones who emerge not just unscathed but positioned to benefit when fear drives irrational decisions across the system. And it's not merely theory. It is strategy proven through decades of market cycles. For the individual watching this unfold, the takeaway is actionable. Maintain a focus on fundamentals, keep liquidity available, avoid unnecessary risk, and be prepared to act when opportunity presents itself amid widespread panic. Buffett's insights often seem deceptively simple, but their power lies in execution. Doing what is counterintuitive, resisting herd mentality, and committing to a disciplined approach over time. And as we reflect on these lessons, it becomes apparent that the secret prediction is more about a mindset than a forecast. An awareness of vulnerability, an appreciation for patience, and the readiness to act decisively when conditions align. This mindset extends beyond financial markets to decision-making in general, embodying a philosophy of preparedness, rationality, and strategic patience. And in observing the current environment, one can see echoes of past excesses. Overvaluation in certain sectors, high levels of debt, exuberance in retail and institutional investors alike, and widespread complacency. These are the very conditions Buffett watches for, combining quantitative analysis with qualitative judgment, and always maintaining an awareness of human psychology. The lessons resonate further when you consider the practical steps he advocates. Keep a margin of safety, focus on durable business models, understand intrinsic value, and resist the temptation to speculate. And for those watching and thinking about their own portfolios, this advice translates into concrete actions. Review exposure, assess risks, identify strong businesses with solid fundamentals, and maintain liquidity to capitalize on opportunities when the market inevitably reacts. Furthermore, Buffett emphasizes understanding the business, not just the stock. It's about analyzing cash flow, competitive advantages, management quality, and long-term sustainability. This depth of understanding provides a shield against panic-induced decisions, allowing investors to act rationally when others are driven by emotion. And embedded in all this is a call to discipline, echoing the wisdom of Benjamin Franklin, who suggested that an ounce of prevention is worth a pound of cure. Buffett's preparation, his strategic patience, and his keen observation of human behavior all serve as a modern embodiment of this principle. And while many chase headlines and short-term predictions, the real insight lies in quietly monitoring fundamentals, maintaining readiness, and being positioned to act decisively when the next crash reveals itself. Imagine walking through the world of investing with someone who has been described as the Oracle of Omaha, a man whose name alone commands respect across boardrooms, trading floors, and living rooms alike. Warren Buffett, the legendary investor whose strategies have turned modest sums into billions over decades, has long been studied not just for the wealth he generates but for the wisdom he shares. Often cryptic, always profound. Now, picture that same Buffett leaning in to give a subtle warning about the next crash, a signal most will overlook unless they truly understand the patterns of history, psychology, and finance he's been observing for a lifetime. The way he speaks, measured and deliberate, often hides deeper truths between the lines. He's not someone who shouts predictions. Instead, he drops hints wrapped in analogies and reflections that echo the thought of great philosophers like Seneca or Marcus Aurelius, reminding us that preparation and patience outweigh panic and impulsiveness. Imagine him noting that markets move in cycles, that human behavior often repeats in predictable ways, and that the key to survival isn't knowing the exact timing of a downturn but recognizing the signals that accompany it. Buffett has often emphasized the importance of cash flow, the intrinsic value of businesses, and the need for a margin of safety. Lessons that are far more than technical. They are moral in nature, an ethical compass for navigating the chaos of financial markets. And yet, there's a subtle tension in his words, as if he's aware that despite the decades of accumulated knowledge, the average investor is still prone to succumb to fear and euphoria, the twin engines of market extremes. He might say something about being fearful when others are greedy and greedy when others are fearful. And on the surface, it seems simple, almost like a catchy quote for a coffee mug, but the deeper lesson is about emotional discipline, understanding history, and cultivating the courage to act when the herd is panicking. It's the kind of wisdom that forces you to pause, to consider not just your portfolio but your mindset, your relationship with risk, and your readiness for events that the headlines will scream about only after the fact. Think of it as a secret language for those willing to listen. The quiet signals in economic indicators, corporate balance sheets, and consumer sentiment reports that most people ignore. Buffett often points to the importance of insurance companies in his investment model, using them as a metaphor for liquidity and opportunity. Capital available at the right moment to deploy when others are retreating in fear. There's a lesson in that for any investor. The next crash, whenever it comes, is less about timing and more about positioning, about being structurally prepared to benefit when fear drives irrational decisions across the market. And if we pause to consider his history, he has never shied away from acknowledging mistakes, yet he has consistently learned from them, iterating on his approach over decades. That humility, combined with relentless study, is part of what allows him to recognize patterns others miss. Now imagine a scenario where the warning signs align with what he's quietly been observing. Overvalued sectors, leveraged debt piling up quietly in corners of the financial system, and widespread complacency among retail and institutional investors alike. In such moments, Buffett's advice is subtle, often couched in reflections on patience and prudence, but the implications are enormous. He might remind us that price is what you pay, value is what you get. A statement that resonates with timeless economic wisdom, reinforcing the idea that speculation divorced from underlying value is inherently dangerous. And while some may chase short-term gains, Buffett's message is clear. The real power lies in understanding the fundamentals, in having the foresight to recognize vulnerabilities before the panic begins. This is where his secret prediction becomes less about a date on the calendar and more about the state of the system itself. It's about reading the signs of excess, knowing where leverage is built up, and understanding which businesses can withstand shocks versus those that will falter. And there's a psychological dimension too. Buffett knows that fear is contagious, that when markets tumble, rational analysis often gives way to mass hysteria. He's lived through crashes before, the Black Monday of 1987, the dot-com bubble of 2000, the financial crisis of 2008, and his observations are consistent. Markets are cyclical, human behavior is predictable, and opportunity often comes dressed as disaster. That idea alone is enough to make you rethink how you approach your investments. He teaches that a crash is not merely a financial event but a social one, a reflection of collective psychology amplified through the mechanisms of credit, leverage, and liquidity. And as we think about what's next, we must consider not only what the signals say but how prepared we are to respond calmly, without succumbing to panic or greed. The challenge is always to act rationally in a world that rarely behaves rationally. Buffett's framework encourages investors to focus on quality, on durable competitive advantages, and on the long-term horizon. He frequently mentions businesses with predictable earnings, strong management, and products that people need regardless of the economic climate. It's not flashy, it's not exciting in the moment, but it is shockproof in a crisis. That's where his secret prediction lies. Not in pointing to a day or week when the crash will happen, but in framing how to survive and even thrive when it does. And if we examine his strategy historically, we notice a consistent pattern. He maintains liquidity, reduces unnecessary risk, and waits patiently for markets to present bargains created by fear, uncertainty, and overreaction. There's a profound lesson here about patience as a superpower in investing, echoing Aristotle's reflection that virtue lies in moderation, in knowing when to act and when to restrain oneself. Consider, too, the role of information. Buffett has always valued independent thinking over noise, long-form analysis over headlines, and reasoned judgment over rumor. In the age of 24/7 news cycles and algorithm-driven market hysteria, this discipline is more valuable than ever. He teaches that understanding the broader economic context, the leverage embedded in the system, and the psychological biases of investors provides a strategic advantage that most fail to exploit. Now, think about how this applies to the everyday investor. It's not necessary to predict the exact day of the next crash, but it is vital to assess exposure, to understand the fragility of investments, and to ensure a margin of safety. Buffett's philosophy is about defensive yet opportunistic positioning. Protect your capital, seek value, and be ready to act decisively when irrationality prevails in the markets. And there's a subtle art to this, a blend of quantitative analysis and qualitative judgment. He looks at earnings quality, management integrity, debt structures, and market psychology, all intertwined to reveal the underlying risk profile of an asset. This holistic perspective allows him to anticipate vulnerabilities in a way that is often invisible to those focused on superficial metrics or short-term trends. He reminds us that history